Good afternoon, class. Today I'm going to discuss Chapter 1, Problem number 7, which deals with computing the investment of a business combination using the equity method. Number 7 reads, in January 2017, Domingo Incorporated acquired 20% of the outstanding common stock of Martez Incorporated for $700,000. The investment gave Domingo the ability to exercise significant influence over Martez, whose balance sheet on that date showed total assets of $3.9 million with liabilities of $900,000. Any excess cost over book value of the investment was attributed to a patent having a remaining useful life of 10 years. So in 2017, Martez reported net income of $170,000. In 2018, Martez reported net income of $210,000. Dividends of $70,000 were declared in each of these 2 years. What is the equity method balance of Domingo's investment in Martez Incorporated at December 31st, 2017? So first we want to pull out our data from the problem. So here we know they acquired 20% of the outstanding common stock of Martez for $700,000. Martez, whose balance sheet on that date showed total assets of $3.9 million. So there's assets of $3.9 million and liabilities of $900,000. Any excess cost over book value of the investment was attributed to a patent having a remaining useful life of 10 years. In 2017, Martez reported net income of $170,000 and net income of $210,000 in 2018, and dividends of $70,000 were declared for both years. So what are they asking us to do? What is the equity method balance of Domingo's investment in Martez? So they want you to compute the investment. So again, we're gonna prepare a schedule. We're going to compute our investment. And so in preparing our schedule, we're gonna follow the same format as before. We're gonna recognize the acquisition price, the income, less any dividends, less the amortization, this time of the patent, and that's gonna give us our investment. So acquisition price. So our acquisition price was $700,000. We're going to compute income for 17 and 18. So 2017 and 2018. And so for 2017, it was $170,000. It was given to us. We multiply that by our 20% investment. It's $34,000. Right here. Let me get rid of this 3. What? Okay. So let me rewrite that. 34,000. In 2018, it was 210,000 times our 20% investment. Comes out to 42,000. Then we're gonna less the amortization. And so here with the amortization, we're going to have to compute the difference between the book value and the acquisition price. And so we know the original acquisition price was $700,000. And the book value is $3 million. So that $3 million times 20% is $600,000. So the excess of the book value is $100,000. And so that's attributed to the patent. And so the patent has a 10-year useful life. And so you'll divide that 100,000 by the 10 years. And that'll give you $10,000 per year. And so this $3 million book value is coming from, if you take the total assets and total liabilities of the company at the time of acquisition. So the assets, the total assets were $3.9 million and the liabilities were $900,000. So they gave them a value of $3 million. And then we purchased 20% for $700,000. So once you've computed this to find out the excess for the patent in the 10 years, then you take that amount and put it into your schedule. So it comes over here in our schedule, and we're in for 2017 and 2018. We're going to reduce this amount by the investment by 10,000. Then we're going to further reduce it by the dividend that was issued. So for 2017 and 2018. And what was given to us, it was $70,000 a year. %20 would be less $14,000. And again, $70,000 for 18. 20% is another $14,000. So now the investment in Martez at 12/31/18 is a result of all these transactions, which ends up being $728,000, which is answer A. So here in this problem, we prepared the schedule to come up with the investment. We took the acquisition price less adding in income for the year that was recognized, 20% of the amount they recognized for each year. Then we less the amortization and we less the dividend that was issued. And we computed the amortization over here by determining the excess book value and dividing it out by the patent, which had a 10-year useful life. And in this equation, to come up with the book value, we used the $3 million, which is actually the net of the assets and liabilities that we assumed when we purchased the company. Thank you.